Welcome to this video on the financial crisis of 2008. In this video, we will discuss the causes of the crisis, its impact on the global economy, and the actions taken by the Federal Reserve to mitigate its effects. The financial crisis of 2008 was caused by a combination of factors, including subprime mortgage lending, a housing market collapse, over-leveraging, lack of regulation, and globalization. Banks and other financial institutions were lending money to people with poor credit ratings, who were unlikely to repay the loans. These risky loans were bundled together into mortgage-backed securities and sold to investors. As more and more subprime borrowers defaulted on their mortgages, the housing market began to collapse, leading to a decrease in the value of mortgage-backed securities. Many financial institutions had taken on too much debt and had invested heavily in mortgage-backed securities, facing significant losses. The financial industry had become increasingly deregulated in the years leading up to the crisis, with few restrictions on risky lending practices and little oversight of financial institutions. The interconnectedness of the global financial system meant that the crisis quickly spread from the United States to other countries, causing a worldwide economic downturn. The crisis had a severe impact on the stock markets, with many major indices experiencing sharp drops. The Dow Jones Industrial Average lost over 50% of its value between October 2007 and March 2009. The crisis began with the collapse of the U.S. housing market, which had been fueled by subprime mortgages and other risky lending practices. The crisis quickly spread to other areas of the economy, with many banks and other financial institutions facing insolvency. The U.S. government stepped in with a massive bailout program to prevent a complete collapse of the financial system. The Federal Reserve played a significant role in the response to the crisis. It provided liquidity to financial institutions, cut interest rates aggressively, implemented quantitative easing, coordinated with other central banks, and implemented regulatory reforms. The actions taken by the Fed were aimed at stabilizing financial markets, preventing a collapse of the financial system, and stimulating economic growth. Many experts believe that they played a significant role in preventing an even more severe economic downturn. The global financial crisis of 2008 was a catastrophic event that had significant impacts on the world's financial markets. While the world's economies have rebounded from it, the lessons learned from this crisis remain highly relevant today. The crisis was a result of multiple factors, including a housing bubble in the United States, complex financial instruments, and inadequate regulatory oversight. One of the key lessons from the crisis was the need for stronger regulation and oversight of financial institutions. The 2008 crisis demonstrated that lax regulation and insufficient oversight can lead to systemic risk and threaten the stability of the entire financial system. In response, governments and regulatory bodies around the world implemented a range of reforms, including tighter capital requirements, stress testing, and increased transparency. Another important lesson from the crisis was the need for greater transparency in financial markets. Prior to the crisis, many financial instruments were highly complex, with opaque pricing and unclear risks. This lack of transparency made it difficult for investors and regulators to fully understand the potential risks associated with these instruments. As a result, many investors suffered significant losses when the crisis hit. Today, efforts are ongoing to increase transparency in financial markets and make financial instruments more understandable and accessible to investors. The crisis also highlighted the importance of risk management and the need for financial institutions to better understand and manage risk. Many financial institutions were caught off guard by the severity of the crisis, as they had not adequately assessed the risks associated with their investments. Today, many financial institutions have implemented more rigorous risk management frameworks and are better equipped to manage risks in a rapidly changing economic environment. Finally, the 2008 crisis demonstrated the importance of international cooperation in addressing global financial issues. The crisis was a truly global event, affecting economies around the world. In response, international bodies such as the G20 and the International Monetary Fund, IMF, worked together to coordinate a global response and prevent a full-blown economic collapse. Today, international cooperation remains crucial in addressing global financial issues, such as during the COVID-19 pandemic. Overall, the lessons learned from the 2008 financial crisis are highly relevant to today's financial markets. They highlight the need for stronger regulation, greater transparency, better risk management, and increased international cooperation. While the world's economies have made significant progress in addressing these issues since 2008, ongoing efforts are needed to ensure the stability and resilience of the global financial system in the face of current challenges. That's all for this video on the financial crisis of 2008. I hope you found it informative and useful. If you have any questions or comments, please leave them below. Don't forget to like and subscribe for more videos like this one. Till the next video, ciao.